Hi there, this is Victor here. In this video, I'm going to give you my top 2 market predictions for 2023, so you know what to expect in 2023 and learn when the market will likely start recovering. Before I start, I'll give you some context first. At the time of making this video, the S&P 500 is still down almost 20% from its most recent peak. The tech-heavy Nasdaq 100 is down 34% from the most recent peak. And if you're a growth investor, and if you invested in many high-growth stocks, your portfolio is likely down more than 40% from the most recent peak. Right now, if we look at the market, I think there's a huge disconnect between business fundamentals and stock performance. Even though many companies' long-term fundamentals have not changed, most US stocks are down a lot mainly because the Fed is maintaining very restrictive policies and because the Fed is planning to increase the terminal rate to above 5% in 2023. As of now, the Fed's main goal is to slow down the US economy in order to bring inflation back to the 2% target. Because of high inflation and high interest rates around the world, many economists expect that the US will be in a recession in 2023. Also, many countries around the world are expected to be in a recession in 2023. If you're an investor, here are the most important questions you want to know. How high will the Fed raise its interest rate? How long will the Fed maintain high interest rates to force inflation back to the 2% target? And when will the Fed start pivoting and lowering rates? I'm going to answer these questions in this video and give you my top 2 predictions for 2023. I will explain why the Fed will not pivot and lower rates in 2023, why dividend stocks will still perform better than growth stocks in 2023, and what stocks I will be investing in when inflation is still high. If you like this video, make sure to hit the like button, subscribe, and turn on the notification button. I will continue to make many excellent investing videos a week that will help you become a great investor. Also, if you like this channel and want to support it, check out my Patreon blog in the video description and become a premium member. Our goal is to create the best intelligent investor community that will help all our members grow their stock portfolios to over 7 figures over time. With your support, we'll be able to stay independent and create many excellent stock analysis and investing videos a week that will help you become a great investor. The link is in the video description. Take a look, let's start. My first prediction is that the US Fed will not pivot or lower rates until at least 2024. This means I believe it will still be a bear market in 2023 because the Fed is not planning to lower rates until at least sometime in 2024. I believe the market will rebound quickly and become a bull market again when the Fed indicates that they will start pivoting and lowering interest rates very likely in 2024. For this to happen, the Fed will want to see inflation coming down significantly to the 2% target in a sustained way. This from the most recent FOMC meeting. The US Fed Chair Jerome Powell said this.
I wouldn't see us considering rate cuts until the committee is confident that inflation is moving down to 2% in a sustained way. So that's the test I would articulate. And you're correct, there are not rate cuts in the SEP for 2023.
As of now, the market has an opposite view compared to the Fed. The market and many Wall Street analysts expect that the Fed will start lowering rates in late 2023 when they see that the US inflation comes down significantly to the 2% target. Personally, I think the market is overly optimistic, thinking that the Fed will start pivoting by late 2023. In this high inflation market, I think it's better to be more conservative and prepare for more surprises than to be overly optimistic. Here's my prediction. As long as rates are high and the US Fed is not pivoting yet until 2024 or later, many investors and large institutional investors will still stay away from stocks no matter how undervalued stocks are. But when the Fed starts pivoting and lowering rates, many investors and large fund managers will start allocating their capital to stocks again. Investors can choose to invest in different asset classes depending on the expected returns and risks. These asset classes can be stocks, bonds, ETFs, certificates of deposit or CDS, high-yield savings accounts, US Treasury bonds, real estate, and even cryptos. For example, in Canada, you can buy a guaranteed investment certificate, also known as GIC, from a local bank. This GIC can give you a guaranteed interest rate of around 4% to 5% each year for 1 to 5 years. This GIC is principal protected and is almost risk-free. The only risk is that it does not protect you against inflation. For example, if inflation is 6% and you're earning a 5% interest from a GIC, you're still losing your value of money over time. In the US, you can buy certificates of deposit or CDS that are also principal protected. CDS can give you a guaranteed interest for a fixed period of time, such as 6 months, 1 year, or 5 years. For investors who are worried about the stock market and how volatile it can be, it makes more sense to invest in these GICs and CDS that are principal protected if these guaranteed investment products offer high interest rates. As long as the Fed is keeping rates high, many investors would rather invest their money in guaranteed investment products, such as CDS and high-yield savings accounts, than invest in stocks, ETFs, and actively managed funds that have more risks. This is why I think the market will still be a bear market in 2023. If 2023 turns out to be a bull market, I would not mind at all because I know many stocks are oversold and undervalued now. The market will eventually recover and reach a new peak again because of the US long-term economic growth. Personally, I believe the market will recover quickly when the Fed starts pivoting and lowering rates likely in 2024. These are the most important tests for the market to recover. First, how high will the Fed raise the Fed funds rate? This is known as the terminal rate or the peak rate. The Fed is planning to raise the terminal rate to above 5% in 2023 in order to slow down the US economy to curb inflation. Second, how long will the Fed keep its high interest rates and keep restrictive policies until inflation is back to the 2% target? And third, when will the US inflation drop back to the 2% target in a sustained way? In my opinion, I believe the US inflation has already peaked. According to the latest data here, you can see the US PCE inflation was 5.5% in November 2022. The PCE inflation has been trending downwards since June 2022. I believe this is a very good sign, showing that the US inflation will eventually drop back to the 2% target again. This from the most recent FOMC economic projection. The Fed expects that the US PCE inflation will drop to 3.1% in 2023, 2.5% in 2024, 2.1% in 2025, and the 2% target in the longer run. During the same period, the Fed expects that they will raise the Fed funds rate to above 5% in 2023. Assuming there are no large economic shocks and surprises going forward, the Fed expects that they will start lowering rates starting in 2024. Here's the important part. When the Fed starts pivoting and lowering rates, stock valuations will increase a lot because the cost of capital will be lower. Borrowing costs will be lower for both consumers and businesses, which will encourage consumer spending and business spending. In my opinion, the market will eventually recover and reach another peak again because of the US long-term economic growth. Realistically, I think it will take several years for the US inflation to drop back to the 2% target. It's not going to happen within a year in 2023. My second prediction is that most undervalued dividend stocks will still outperform most growth stocks in 2023. Typically, when interest rates are high, most dividend-paying stocks will perform better because they tend to have better business fundamentals, more established business models, better cash flows, better earnings, and better finances. And when interest rates are low, many growth stocks tend to perform better because the cost of capital is much lower, borrowing costs are much lower, and they can often finance their growth by issuing more debts without paying high interest. As long as rates are high and the Fed is maintaining very restrictive policies, I believe most growth stocks will still underperform because their stock valuations are largely dependent on their future earnings discounted to the present day. I will give you an example here. Amazon stock is a mega cap growth stock. Amazon stock is down as much as 55% from the most recent peak. Personally, I believe Amazon stock will still underperform compared to many dividend growth stocks as long as interest rates are still high. Growth stocks tend to perform the best when interest rates are low. If you look at this here, you can see Amazon's total revenues have been growing consistently for many years already. But Amazon's free cash flow actually decreased significantly in the past 2 years because Amazon overexpanded during the pandemic period. Amazon's management made a mistake and believe e-commerce will continue to grow at a high growth rate even after the pandemic is over. Amazon hired too many workers and overexpanded its fulfillment network. Now Amazon has started laying off employees to cut down costs. The important part is this: Amazon is still losing a lot of money from its online store, third-party seller services, shipping services, and Amazon Prime almost every quarter. Amazon's most profitable business is Amazon Web Services or AWS. AWS is the largest cloud provider in the world. AWS contributes the most profits and most free cash flows to Amazon every quarter. Let's look at Amazon's biggest cloud competitor, Microsoft. In comparison, Microsoft's stock is down as much as 30% from the most recent peak, mainly because of the US Fed's rate hikes. In my opinion, I believe Microsoft will perform better than Amazon in this high inflation and high interest rate market because Microsoft's business model is much more profitable than Amazon's business model. Microsoft has very consistent revenue growth, operating income growth, and free cash flow growth almost every quarter. Also, Microsoft is a dividend growth stock. Microsoft has been growing its dividends consistently for over 18 years already. During this period, you can see Microsoft stock has also been growing gradually. This shows Microsoft has a very strong business model, strong fundamentals, and consistent earnings growth over time. Here are the key takeaways. I will share with you what stocks I'll be buying going forward. Going forward, as long as inflation is high and the Fed is keeping high rates and restrictive policies, I believe most dividend stocks will still outperform most growth stocks. For example, if you look at this year, Microsoft outperformed Amazon in the past 1 year. Microsoft also outperformed Amazon by a lot in the past 5 years. Personally, I will be investing in many more dividend growth stocks that are undervalued going forward because dividend growth stocks tend to have stronger business models, stronger fundamentals, consistent earnings growth, and consistent free cash flow growth over time. For example, I will be investing in a lot more Apple, Microsoft, Visa, MasterCard, and American Express going forward. They are all dividend growth stocks. In my opinion, they have very strong business models, strong fundamentals, large economic moats, consistent revenue growth, and consistent earnings growth over time. When inflation is back to the 2% target and when the Fed is lowering interest rates again, their businesses will still benefit a lot. Now, all these are only my opinions and my analysis based on my research. They are not financial advice. There are always risks associated with investing. You will need to do your own research and do your extra due diligence first before investing in anything. Thank you for watching this video and supporting our channel. This is Victor from the Intelligent Investor channel, and I will see you in the next video.